Have you ever wondered how, in the span of a few days or just a few hours, the price of a stock can fluctuate considerably? Is it due to a change in the fundamentals of a company? Well, likely no. So why is this so? The answer is that while in the long term, the price of a stock should eventually approach its intrinsic value, in the short term, the movement of stock prices works something like a voting machine, impacted by the collective behavior of the crowd.
The price of a stock is a function of its current supply and demand, just like how other things in life are priced. It's simple economics. A price is established once we have a willing buyer and a willing seller transacting. In financial markets, there's an adding up constraint. For every buy, there must be a sell.
Stock market rallies are fueled by buying and continue as long as more people buy into the market. So this is what you'll usually see. Initially, when the market starts to go up, most people hesitate to buy in because they are still uncertain about the stock or the market. But eventually, as they see the market go higher and higher up, the fear of missing out starts to kick in, and so they buy in. And it's also not just about feeling FOMO. People also feel this sense of safety when we are doing what most other people are doing. Just like if you recall back to the beginning when the Singapore government were in the midst of securing COVID vaccine supplies, if you recall back to those conversations that we had with our friends about whether or not we are going to take up the vaccinations, most of the responses were along the line of, I want to take and I will take, but I don't want to be the first to take. I'll wait until more people have taken up, then I'll go and take my vaccination.
Yeah, some may even say they don't want to be vaccinated, but when they see more people getting a vaccination, they soon change their mind because of the fear of missing out and the sense of safety now that they see majority have done it.
Right, so back to the stock market. At some point, all of the people out there that are potential buyers buy into the market. Then, once there is no one left to buy, the market rally comes to an end and a correction begins. This is how all short-term rallies end, how bull markets end, and even how upward moves in individual stocks come to an end. This is what really fuels stock market movements. What happens is that investor psychology is closely related to the major tops and bottoms in a market cycle. Let me give you a real-life scenario. Some of you may have experienced wanting to buy a stock, but it seems that the price only kept going up. So in the end, you thought to yourself, I'm not going to wait anymore, I'm just going to buy it now. But shortly after you bought in, the price started to decline. And this time, you thought to yourself again, wow, I really got no luck. But is it really because of luck? Is it all about luck?
Towards the end of a bear market, we will still have most people holding on to a heavy cash position or are staying out of the market. And that is because they feel uncertain about the market and are staying cautious, feeling that it's too risky to buy now. However, once they do buy into the market, when they feel that the price point has gone up and is safe enough, they become bullish on the market and will be open to accept bullish arguments and theories, whether from mainstream media or other investors' sentiments. Hence, as we approach the market top, therein lies the problem, where almost everyone now is bullish and everyone who wants to be in is already in. Eventually, there will be no one left to buy at an even higher price to push the price up any further.
Conversely, during big declines, the opposite happens with investor psychology. As the decline starts, most people just hold on, thinking that the decline is temporary and still remain optimistic about the market. But as market participants fear that the market may continue to trend lower, some of them start to sell out and become bearish on the market. The bearish momentum will start to pick up as more and more people sell, thinking sell must faster leave as more people accept the bearish arguments. Finally, nearing the market bottom, bearish sentiment is at its maximum. At the bottom of a market is what we term as capitulation, where the most panicked seller of all sellers sells off at the lowest possible price finally. Once the biggest bear of all bears give in, there will be no more sellers left, as those who wish to let go have let go. The cycle then reverses upwards as any other seller is only willing to accept a higher price from the new wave of buyers. Big success in the market means having a deep understanding of the investing crowd psychology to understand what it really means when we see prices moving up and coming down. We must stay objective and stay in alignment with what the stock market is doing, because the real money is made by making the right decisions at these very critical moments.
In practice, we humans tend to find comfort with the like-minded people and in numbers. Our beliefs then strengthen with the type of content that we choose to look at selectively. Thus, it's psychologically easier for investors to buy when the stock price is at the top. Buying at the top actually feels like a good thing to do because many others are doing it and supporting an idea. That's why even during a bull market, an average investor usually loses money because he bought them too late and at a price that's too high, and to later on sell at a lower price when the market cycle reverses. The problem ingrained in us is that we are so used to follow the crowd. We are told that the collective opinion of a group of people will definitely of a higher quality than that of a single person. Why the many are smarter than the few? And so on and so forth.
But investing with the crowd in the financial markets will not allow you to make outsized returns. At key tops or bottoms of a market cycle, the majority are usually wrong, and that is when they agree with one another. So we must be able to identify that and avoid moving in a herd. It can be really tough, especially during periods where there is extreme bullish or bearish level of sentiments. And when you then share your contrary views, most people are just going to react violently against what you say. Bloomberg TV, CNBC, the press, and the opinions of the majority of the masses, they will all be against you. But the fact is that if let's say we are already at the top of a bull market, the more people there are that tells you that they are still extremely bullish about the market, that very existence proves the point that most of those people who want to buy have already bought it. Hence, it is not easy to always be right and in non-conformance with the crowd.
The only way we can avoid being influenced by the wisdom of the crowd is to have a system or strategy when it comes to investing and a way to help us to interpret what the market action is trying to tell us. And this system must work so well enough in practice that on any day, you will believe in it more than what any experts or financial editors tell you.
The interesting thing is that most people will say that any market beating techniques or strategies do not exist. Because if they did, then everyone would have done so, and everyone would have done well. But the thing is that in the first place, many people do not bother to learn properly, because most of us are just too tired or too busy over our daily jobs. And there are also some people who are not interested in learning at all. They are more interested in making easy money and quick money. So they will rather listen to expert opinions or the advice of analysts. Or some of them will just leave their money to someone they believe is an expert at managing money, who actually makes more money through commissions by selling investment plans, rather than the money that they make in the stock market itself.
To sum up, it's important to keep an open mind and to have an investment system that gives you conviction and help you with your decision-making process. Instead of pure contrarian investing, which is to simply just to go against the crowd for the sake of doing so, the important thing is to do so when you have the conviction and be correct about it. And that is when you make the fortunes.